All right, welcome everybody to Stock Market Crashes for Dummies. If you guys don't know who I am, my name is Jonathan Lee. I am the president of the DC chapter of the Foundation for Financial Education and also the DC director of the Financial Education Partnership. We have run this webinar a couple times previous, and we've gotten great feedback, so I wanted to reinvite our special guest speaker today, Ray Hobson, to join us on this call. You know, I know Ray's been around a little bit longer than I have. He has nearly 3 decades of experience in the financial services arena. He was also voted Financial Advisor of the Year in Annapolis, Maryland. This is going on 3 years in a row. And we have really been very blessed to be able to have his counsel and have him volunteer through our foundation to host these types of educational events, as well as provide one-on-one counseling for people that are requesting more help from his organization. He runs an office called RH Advisory out of Annapolis, and it's a family-run business. And you know, you guys will get to know more after this workshop today. But of course, you can see his picture on here, and I do have to make a quick comment about this picture. Of course, he's better looking than I am, but for some reason they felt like they needed to blur me out a little bit because they didn't want me overshadowing Ray. But obviously, thanks again, Ray, for joining us today. I can hear you chuckling, but I really wanted everybody to get the opportunity to hear you, especially with all the stuff that's been going on in the marketplace and some of the strategies and some of the really succinct and important advice that we're going to be talking about today. So thank you, Ray, for joining us. Yeah, how you doing today?
Good. Just getting up this morning and just getting ready to go.
All right, I'm going to go ahead and jump right into the presentation so these guys can have your wisdom. Of course, Stock Market Crashes for Dummies is one of our nonprofit educational workshops. All of our information is on our website, and our phone number and contact information is available on the website as well. I'm going to put up the normal disclaimer that you guys always see at the beginning of each presentation. And of course, this educational presentation is strictly for educational purposes. We're not going to be talking about any products, services, advice, and our foundation does not endorse any product, services, devices, or individuals. So if you are seeking counsel and you want to get professional advice from a licensed individual or advisor in your area, we would definitely recommend you do so, especially when in regards to investments, taxes, insurance, legal, real estate, and other financial instruments. So we're going to be talking about a lot of different things today, and we're going to keep it fairly rudimentary because of the title of this workshop. It is called Stock Market Crashes for Dummies. I don't want to assume that anybody listening today has any specific or extensive knowledge in this area, but I do want people to understand that they don't have to sit back and do nothing while the market is going a little bit haywire. So, in general terms, Ray, I know we tell people this all the time, but it's difficult for them to understand it and really believe in it because it's their own money they see going up and down and all around. But why are stock market corrections good in general? I mean, even though they don't sound great because people could be losing money potentially, but in the long run, why are they actually a positive thing?
Yeah, I mean, corrections are normal, right? The whole concept of the market is not everything goes up all the time, right? It's normal in every kind of investment, including real estate, including stocks, including bonds. Everything kind of goes up and down. So when we've had such a long run of stock market increases over the past really 10 years or so, or a little bit longer than that, really, we expect some of these things to come down. And they are normal. They do happen. This happens to be triggered by the COVID-19 situation, but they definitely are a normal occurrence, and they do, where the market does go up, the market certainly does go back down.
And so this is what they talk about, or they consider to be called a event-driven correction. And these things don't happen very often, and a lot of times they're incredibly unpredictable, and the recovery period can be a lot longer than people realize. And I love the way that you had phrased this before, Ray, but you said recovery doesn't look like a V. It looks like a W. And why is that?
Yeah, so that's the thing. I mean, when you look at this, especially now, being that everything's so unpredictable, the market corrections don't typically look like a V where you say, the market's gone up for so long, and then we have this sharp decrease, and then all of a sudden we go right back up to where we were before after, kind of we get through this. Typically, it doesn't look like that. Typically, what it more often looks like is a W, where you have this sharp downturn. We have a slight uptick like we've had a little bit, and then you typically go back and you retest those lows, and then you get that before you get a back turn up. But again, markets are always up and down, John. We can't predict them, and that's the reason why we tell people don't try to time the market, because it's really impossible to do.
And when you say it looks like a W, what's in my mind is I think like maybe it's like a www dot. It might even be more than one W, because this thing is so unpredictable. This thing may be coming in waves. I mean, we don't really know long term what the end effect is going to be on our quality of life. And I'm thinking to myself, and you've probably heard these Harvard studies also. They are thinking social distancing may go on for years, Ray. What do you think is the potential for people to be thinking about what the effect of the market could be if this goes on for years? Not just, we could find a vaccine and all this other good, great stuff could happen, but if the social distancing and other types of things like that last for years, what can we expect?
Yeah, I mean, John, this is something that has changed our world forever. This is not something that's really going to go away, because not only do we have to deal with this pandemic, but there could be other ones, right? So we're going to have, and I think that people need to understand that we're going to definitely have some volatility in the market. And that's really why you have to have a long-term outlook when you're really talking about investing money in the stock market. Because yeah, this could go on for many years, and we've had some recent upturn, but we really have to be cautious and have to be really smart about what types of investments we go into, and making sure that we have a really good understanding of what our time frame is for our investments, because that really becomes the key.
So I'm going to just tell people a couple technical definitions of some of these terms that will help them. Typically, you hear things called a pullback. Pullbacks tend to happen every 3 to 4 years on average, and this is just the cyclical nature of the market. Some people might consider a pullback a correction, but technically a pullback is about 5 to 9% downturn. And it happens from time to time, but again, the markets can recover from those pretty quickly. A correction is usually between 10 to 20%. And since the 70s, over the last 40 some odd years, corrections have happened about 22 times. So a 10 to 20% downturn in the market leads to correction. Now, if you go to more than 20% correction, which is what we've seen in our adult lives 4 times, we call that a bear market. And I think one of the things that I wanted to ask you today, Ray, is understanding the difference between these different terms, but then people say, well, what's the likelihood we're going to be in a recession? And then how do we turn that into the possibility of a depression? So what should we be considering about this potential recession that we're in, and are there things that we need to do to insulate ourselves from a potential depression, not even just today, but any time in the future?
Yeah, I think it's pretty clear that we're likely going to be in a recession. A recession really is a decline in the GDP for 2 or more quarters. And with everyone out of work and things being the way they are, it's very possible, very very likely that we will certainly be in a recession. Whether we're in a depression or not is yet to be determined. But the depression is declined as a decrease in the GDP of 10% or more in any given year. So we don't know where that's going to fall out. We don't know. But again, it's certainly likely that we're going to be in a recession, but a depression, we're not quite sure. And we have to understand what that means, right? Because it will certainly affect this stock market over a long period of time if we're in a depression. But it doesn't mean that you shouldn't be invested in the market, right? You have to take a look at what your time frame is, and making sure you have a really good diversified portfolio with very good asset allocation.
Yeah, and I've heard people say before, especially when you've advised us, it's not about time in the market, it's about your time in the market. And the likelihood of people making a mistake by pulling out or going into the wrong time is very, very high, because people act on emotion, or certainly they might act out of fear, like we see here. But because of all the stuff that's been going on, what we normally see, Ray, is corporate earnings peak, and then people will sell to get profit, or maybe they're looking at PE ratios and things like that. When there's emotion and fear and event-driven corrections, all that stuff goes out the window. So what should people really be focusing on right now?
Yeah, I mean, one of the things that I talk to people quite a bit about is trying to take the emotion out of your investments, right? And that's where people get it wrong most of the time, John. And it's not one of those things where you say, well, what do I do? Do nothing. You have to do something, right? You can't just sit there and not and just say, well, it is what it is. I mean, any good advisor will tell you if you have a good asset allocation, really now is the time to do rebalancing of your portfolio. And like I said before, if you do have a good asset allocation and which is appropriate for your time frame that you're investing with, then what you should be doing now is reallocating that portfolio or rebalancing that portfolio. And so what does that mean? That means if I, for example, John, if I have stocks, I have a portfolio that's 50 or 60% stocks or even 70 or 80% stocks, and I have the fixed income piece or whatever that's maybe 20 to 15%. What I really want to do at this point is I want to be selling those assets that haven't gone down in value or cash that I have, and I want to be buying. I want to be buying those equities that have really gone down in value because that's what you're supposed to do. The whole premise of the market is to buy low and sell high, right? The problem that most people have is they don't know when to sell, right? They say, oh, the market's doing fantastic. I just keep on going. I'll just keep pumping money into it. No, when you have a certain gain in a stock, you want to be able to make sure that you capture that gain, take that and then reinvest it into other things that maybe don't have a gain. So it's really important at this point in time to rebalance your portfolios and not fall in love with stocks. I tell this to people all the time, and people are very in love with certain stocks. Apple, for example, is one. I had a client that was just really in love with his Apple stock. And I said, that's great. And I love Apple stock too. However, we can't hold it forever. And Apple doesn't love you, right? You should buy a stock. You should buy a stock or you should buy any equity because you want to make money in that stock, not because you're in love with that company. So you have to understand that, yes, we want to buy things when there are good values. We want to sell things when we've increased in a certain amount or we've taken out what we wanted to make out of that and then reallocate those assets in other places.
And I've been studying sort of the portfolios and the performance of things you're talking about, Ray, and it just really hits home with me. Doing nothing is not the right thing. The path of least resistance of just sitting there, and people have come and talked to me, and they said, oh, I haven't talked to my advisor in 6 months or 3 months. I'm like, what are you talking about? This is the time when those advisors are really going to provide their value. Because it's not when everybody's making money, it's fine. But in these volatile times, the rebalance example you gave is so critical because you have to keep your portfolios in line with what's going on. And the only way to really do well during the volatility is to be rebalancing. And I know some, yeah.
Yeah, you're absolutely right, John. It's absolutely the worst mistake. If your advisor or anybody you're working with or yourself is telling you to do nothing, you really need to get some different advice because rebalancing in a time like this is crucial to performance in your overall portfolio. Absolutely crucial.
And some of the greatest minds, the financial minds of modern times, are talking about during the market downturns. It says right here, increase our ownership in great companies. Warren Buffett, Jack Bogle, Mr. Davis, founder of Davis Advisors, all of these guys would look at this and be all over the opportunity to own more of the value positions that they would want to own. And I think that's really, really crucial. I'd like to go back
for that, by the way.
And they're absolutely doing it, right? I'd like to go back and see. There's another slide I need to show you guys. I just realized it's not in. There we go, right here. I want to just go back just because a lot of people don't understand the math behind these market corrections and downturns. And this is really important because you've told me before, Ray, and it makes total sense, but you got to see the numbers. If you have $100,000 invested and you lose 30%, you go down to $70,000. If you get your 30% back, you don't even break back to even, right? Why is that?
That's correct. Yeah, it's just the way the math works, John. I mean, if you, again, like you just said, you really have to get on a 30% downturn on your market, on your performance, you have to get 42, almost 43% just to break back to even, because that's just the way math works, right? So if you can actually rebalance your portfolio and you can buy equities when they're at a lower point, then you can actually lower that amount of as far as the rate of return that you have to get just to get back to even. And that's why rebalancing, like we talked about before, is really crucial. It reduces that amount that you have to get in order to get back to where you were before.
And this slide, I want to pay particular attention to here because this shows you the math between why the rebalancing is so crucial. So if you have $100,000, right, and somebody went negative 50%, so now you only have $50,000 left. If you can get more money into that $50,000 position that you had before, if you just go back to even, the new money that you put in there, Ray, the new money that you added during the rebalance, it doubles. You get 100% return if the market just recovers from a 50% loss. That's incredible when you look at it that way.
Yeah, it really is. I mean, again, it's very important, and it just really comes back to what we just said before, John, is doing nothing is a major mistake. Because if you, like we just talked about, if you do nothing, right? If you do nothing, you have to get a 43%. You've lost 30, but you got to get 43. So that would tell you right off that you absolutely can't do nothing. You have to really do some things and really take ownership of your portfolio and make some moves when the time is right.
And obviously, a lot of people aren't exactly in tune with how to do that and how to manage these portfolios on their own. And that's why we are so, we really, really advocate getting some professional advice. And it doesn't have to be from Ray, but somebody with Ray's type of experience and knowledge is really crucial to help you and your family manage your finances properly. And what I've seen from my personal dealings with Ray and Ray counseling our clients and doing our educational workshops for us is the investment advice is just the beginning of that. Right? We have to tailor the investment advice and parlay that into tax advice, estate planning advice, retirement planning advice, because that's what we're saving and investing for. So these things are all related. Ray, I get really frustrated when I help review somebody's positions and I help review their overall financial strategy, and I see that they, for example, they have the exact same investments in a retirement account as they do in a non-retirement account. It's just like a formulaic approach, and it's not being tax managed, and there's no exit strategy. It really frustrates me. Can you just kind of impress upon our audience today how important the strategy is beyond just the actual investments or products? Why is that strategy so important?
Yeah, because a lot of times, and for the most part, John, most people have their investments in mutual funds. And if you're in a non-qualified account, meaning that you're not an IRA or a retirement plan, but just in a regular non-taxable account, mutual funds are extremely tax inefficient because you have no control over the buying and selling of what that money manager is doing inside of your mutual fund. So a lot of times, John, I'll see where people will come to me and that aren't current clients or are looking for advice, and what they do is they say, well, wait a minute, how come this mutual fund that I was sold had a capital gain this year, so I have to pay taxes on this account that I own, but I didn't even make any money on it? Well, the reason being is because you are sharing in a pooled investment inside of a mutual fund. And so you really have zero control over what gains or losses you have inside of it. And so a lot of times people will have these situations and don't understand exactly what they have. We try to help people with owning things that they have a little bit more control over outside of retirement funds, so that you can actually do some tax harvesting. So for example, a lot of times in November and December, we meet with our clients, and what we do is explain to them, well, if we have gains in certain areas, we have losses in other areas, we can offset those things, or even take losses if we have losses and offset any potential gains. So it becomes really important to understand the types of investments that you actually have and making sure they're in the right types of portfolios, meaning retirement plans versus non-retirement plans.
And so you brought up so many good points based upon what you're just talking about. And I don't know if everybody out there understands the difference between capital gains taxes and ordinary income taxes. But the top bracket for ordinary income taxes historically can be upwards of 35–40%. Right now, and for the foreseeable future, our capital gains taxes are in a special situation. I think I've got the capital gains tax brackets right here. I'm going to pull them up so people can see them. Can you just make a quick comment about the potential benefit of having your assets be subject to capital gains taxes rather than ordinary income taxes?
Yeah, I mean, based on, you're looking at your chart, John, most people are going to be in a 15% tax bracket as far as long-term capital gains. So, I mean, taking long-term gains is much, much better than taking income taxes. So, capital gains, I tell people all the time, capital gains isn't a bad thing, right? It means you made money, right? You want to have some capital gains because it means that you actually have some gain, right? So sometimes you have to take those gains, and much better to take it at 15% versus your average income tax rate at 20 or 25%.
Yeah, it's a much better deal. And one of the things again that startles me is I see people with individual stocks in their retirement account portfolios. So they have portfolios of investments that would be subject to capital gains, but they don't have the capital gains tax treatment because they're in their retirement portfolios. And those same people have non-capital gains tax treatment investments in their non-retirement portfolios, and it should be absolutely switched.
Yeah,
So,
absolutely.
I mean, tax efficiency is a big deal here, and this is the mantra that we always tout, and I know you say the same thing, and I want people to understand this. There's only certain things that you can control. And so we can't ever guarantee that anybody can make more money than anybody else, but we can guarantee you can keep more of it. So you keep more of what you make by paying less taxes. You keep more of what you make by having better, efficient strategies with fees and with, income. And I know a lot of people are feeling a lot of anxiety. I sense it every day, Ray. But I would just say take a deep breath and look at your stuff and understand. Okay, here's what I can't control. Right? I can't control the performance. But here's what I can control. I can control rebalancing. I can control tax harvesting. I can control Roth conversions. I can control capital gains tax rates. I can control my fees. I can control my risk. There's plenty of things that we can spend time on that you can feel good about and feel in control over, especially in these very difficult times. So, Ray, we're going through a lot of really great things, but I need to just jump back into the presentation to make sure we get through all the content real quick.
Sure.
So we're going to talk quickly about dollar cost averaging, Roth conversions. We just talked about tax harvesting. We have webinars, full-blown webinars just on each of these individual topics. So, please fill out the survey at the end of the webinar so that we can invite you to future events. But I don't want to, profess to be giving you guys, sort of global comprehensive advice today. I just want to give you guys a basic education because not everybody knows what this means. So dollar cost averaging, Ray, can you sum up what dollar cost averaging is and why it's so important like right now?
Yeah, so dollar cost averaging really is a concept that most people are actually doing, and they don't even realize they're doing it if they have a 401k and they're contributing to that. Basically, because we know that the stock market goes up and down, if you're consistently putting in the same amount of money all the time, always investing in the market and not trying to time the market, what you actually do is you're buying at high times, you're buying at low times. And so what happens is you actually average your cost of what you paid for certain investments over time. So it's the most effective strategy for investing. And even, when you have large sums of money that you want to invest, I typically don't tell anyone to throw it all in the market in one day. What we typically do is do it over time so that because we can't time the market, John, and nobody knows what's going to happen tomorrow, we really make sure we want to put in money over different times so that we buy at different time frames and get different prices. So that what we end up doing overall is getting an average of those prices versus buying at a high or buying at a low.
So it's one of those foolproof strategies, Ray, where, the way I like to position it is if the market's going down and you're buying more shares, that's a good thing because you'll do really well when the market recovers.
No
And if
question.
the market's going up and you're buying more shares, you're doing real well because you're making more money. So it's
That's
almost like a foolproof strategy. But here's the other thing I want to talk to you guys about in terms of dollar cost averaging. Ray, how important is it that people have a different strategy with money they're adding to their accounts versus the corpus of what they might have already saved for 30 to 40 years if they're nearing or at retirement? How important is it to have a different strategy with those different pools of money?
Yeah, because if you're getting close to retirement, you're looking at or you're starting to look at withdrawals, right? So as you start to take money out of your accounts, it makes a difference if you're have lump sums that you're going to be adding to it. So over time, you really have to adopt some sort of a systematic investment approach in order to be successful.
And I'm going to go ahead and I'm going to flip back as I like to do and just do a quick calculator with you, Ray. The idea that we just brought up is something that we like to call sequence of return.
Yeah.
And the sequence of return is one of the most powerful strategies. We talk about it at almost every one of our webinars. Most people don't know how to accommodate for it. Most people don't have a strategy around it. But understanding and utilizing the idea of sequence of return can dictate whether you run out of money or not. And that's how important this type of idea is. Can we just look at a little bit of history, Ray, right here, like back in the 90s when the market was really hauling and doing well? I remember people, yeah, the dot-coms, right? People were expecting an average return of 15 to 20% a year. That became an expectation.
Yeah.
But then look what happened, and I'm gonna do a withdrawal from this in a second here, Ray. But this is what happens when you just have that buy and hold strategy and you don't rebalance. Look at how much time went by here, Ray, over 15 years. And look what happened with this sort of roller coaster ride that people went on. If people just bought and held and didn't do any proactive rebalancing or harvest or anything, 15 years went by, and what really did they accomplish in 15 years, Ray?
Yeah, I mean, it really makes a big difference, John, especially when you show, I think what you're about to show here in a second is the withdrawals. If you start withdrawing money in a downturn, I mean, that really can affect your overall rate of return as far as what you'll have in the back end. And it's random, right? It could be. We have no idea what the market's going to do tomorrow or going forward. So if the sequence of returns, it becomes crucial, and it makes so much sense to not lose money in a down market versus making money in an up market. So you're much better off giving up a little bit on the top end and with being able to not have losses in the downturn, because those minus 38s, minus 23s, minus 13 make a huge difference when you start actually making withdrawals or using your money in your retirement years.
And I'm going to go ahead and try and illustrate that now, Ray. In fact, I just had somebody come in the other day, and I had asked them, do you know how long it has historically taken to recover from a market correction or downturn? And they didn't really know. But I wanted people to see here that when the market goes down, you don't just lose principal, you lose time.
That's
so
right.
Look at your $1,000,000 that was here in 1999, and then look how long it took to get your $1,000,000 back. That's 7 years. Right, and then the market goes back up, it goes down again, and now it's another 6 years to get back up to $1,000,000. So you don't just lose your money, you lose time. And some people, if you're 40 years old, time isn't as much of an issue. But if you're 55 or 65, time starts becoming a little bit more real to us, and we want to be able to accommodate so that we don't have those corrections. Let me go ahead and put the withdrawal in here. I'm going to put a very simple 5% withdrawal in here. Now look what happens to our principal. And our principal has gone down now in 15 years. And by the way, 15 years represents about half of the average lifespan of somebody's retirement. So the average person is now retired for about 28 and a half years. So halfway into retirement, Ray, how would you feel if you just, kind of bought and held and lost 60% of all your money in the first half of your retirement?
Yeah, that's when you start to get real uncomfortable, John. When you start seeing your $1,000,000 going down to almost $400,000 because of your withdrawal rate, I mean, it really can be a panic situation, right? So you have to make sure that you are seeking really good advice and having someone helping you with understanding how these vehicles, meaning investment vehicles, how they work and moving into retirement. Because if you make the wrong move, you can start to run out of money.
And that's what we're all trying to avoid. Let me show you guys what happens when I randomize these returns. So what this calculator does is it scrambles the order of these returns. It doesn't actually change a single number. It just says, okay, what if we got the same exact returns, the positive 13s, the negative 38s, the positive 21s? What if we get the exact same return but get them in a different order, right? The different sequence. How is that going to affect my retirement? So I'm going to go ahead and click the random button. And what happened was we now got a different sequence. And in this sequence, Ray, we had at the beginning 7 really good years, one little blip at 7 really good years, and all these negatives happened later. So rather than being left with 390 after 15 years, we got left with 690. That's a huge deal, right? And that's a different sequence.
Absolutely. And I think, John, the key point to take away here is to understanding that we don't have any control over that, right?
Mm-hmm.
As far as what's going to actually, what those historical returns are. We don't choose that 9%, that -10, the -38. We don't know when those are going to happen. What we do know is that they do happen. And so because we don't know what they're going to look like over time, we have to make sure that we reduce that -10 or that -23 or that -38 as much as possible so that we can have a more predictable retirement and make sure that we don't run out of money over time.
And I'm glad you said the word predictable, because when you're retired, you want predictability. That's like the most important thing. Yeah. So I'm going to just click this button a couple more times so you can see. Again, I'm not changing the numbers, just changing the sequence. And every time I can literally click this 1,000 times, and you'll get 1,000 different answers. Here's a sequence we're trying to avoid. We would love for you not to lose 80 to 90% of all your money in the first 15 years. But if the sequence happens in the wrong order, we are in jeopardy of having this happen. Let me just go ahead and reset this. I'm going to show everybody what the difference can potentially be if we understand how to accommodate for the sequence of return in a volatility controlled index, as an example. So here in this example, you'll see, as you were alluding to a little bit earlier, Ray, making these negatives turn into zeros, but getting a similar return over time. And I'm going to highlight this, and I do this all the time, and it's just kind of astonishes me every time I do it. You can go from 1 million to 2.2, and you can go to 1 million to 1.5, and you can actually have the same rate of return. Because of those volatility control indexes, and because of the way math works, I'm going to highlight this rate of return right here so you guys can see it. And I know it's small. The average return over this period was 0.05. Right. And you would think, well, gee, if I made $700,000 more over here with the equity index type of strategy, you got to have more money, right? You got to have a higher rate of return, I should say. Well, let me click on these rates of returns, and you'll see here it says 0.056. Right. So it's a 5% return. It's almost identical, yet there's $700,000 more money. So you don't have to always take more risk to make more reward, Ray.
Absolutely. And what happens, John, is it actually becomes more important in your retirement years not to lose money than it is to make gain. In your illustration here, if you look in the first year, you got a 19% return in the index return there, and you only got a 9.75 on the other side. But the difference being is that you didn't get a -10 or a -13 or a -23 in the 3 following years. That makes all the difference in the world. If you have that kind of control and you can reduce, if you think about it now, right? If I could tell you could get a 0% return this year versus a -30 that a lot of people are getting, it makes.
I take it. I would take it all day long.
Everybody would, right? A 0 is a fantastic return in a -30 year. So what we have to understand or help people understand is that math is math, right? We can't change the math. And we don't know going forward what those returns are going to be. So if we can eliminate the downside, it just makes all the difference in the world. It gives you that predictability, John, that we were talking about earlier for people so that they know that the most important thing is that they won't run out of money.
And let me go ahead and use the calculator here, because you'll see here we're taking out the exact same withdrawal from both sides. And watch what happens to your ending balance when I start randomizing the sequence of return. So in this particular sequence, again, it's completely randomized. I'm not changing a single number. You have $400,000 left over here. You still have your $1 million over here. Yeah. If I click it a couple more times, there really isn't a scenario where you're going to ever too deeply into your $1 million. But over here,
that's a really bad one.
Look what just happened. We ran out of money. Do we really want to leave our entire life savings to chance by not understanding how to accommodate for the sequence of return? The sequence of return is something we have total control over.
Sure.
Most people just haven't heard about it necessarily or don't know how to accommodate for it, but this random variability is too great. If I told you you could either have $700,000 or negative $59,000, that's too big of a swing for most people to handle. And if you look over on the equity index side, if we look at volatility controlled indexes, I can click it 1,000 times. There's no scenario where you're going to dig anywhere too far into principle, pretty much no matter what the sequence is. So
because you're eliminating those negatives, and that's really the key. to eliminate those negatives. And you can do it several ways. I mean, there's different things that you can do investment wise, but rebalancing is one of those things that also helps with that eliminating or reducing those negative returns.
That's great. So that's crucial. And doing nothing, as we said earlier, we just want to impose upon you guys or impress upon you guys. That's not the right thing to do.
Yeah,
So
John, one other thing on that, just real quickly,
yeah, please.
um, the, the thing about that is where you see those returns is a lot of times people will, and I've been doing this for 27 years, and I tell people all the time, I don't do what you do. You may be an engineer or a nuclear scientist or whatever the case may be. I don't do that, right? But I do this. And so for you to try to do my job and your job is really, really challenging. And what happens is, most people end up getting those type of returns and not understanding what they're actually doing, and they end up in that scenario, John, where they say, "Oh my gosh, I'm running out of money," right? And that's because you're not seeking professional advice. If I need surgery, John, I'm sure I can go on YouTube and figure out how to do surgery, but I'm not going to do that, right? I really recommend people, and it's really crucial, whether you use us or anybody else, it's really crucial that you seek in professional advice on any sort of investment so that you can understand concepts like this, John, that we're explaining.
Yeah, it is really important. And the doctor analogy is such a great one because even if you go to the doctor's office, you say, "Oh my gosh, I have some serious stomach pain." They're not going to say to you, "We'll take Pepto-Bismol," right? They're going
Right.
to do a full examination because it could be gas, it could be cancer, it could be so many different things. And without doing a thorough examination, they would never know what it is. A lot of people have some, intermediate goals, long-term goals, tax planning goals, estate planning goals. These things are all wrapped up in the type of advice that I know you give your clients every day. But even here's the Roth conversion slide, right? Why is it such an important thing to talk about Roth conversions in the environment that we're in right now?
Yeah, this is a big thing, and actually, especially in this year, as the most people aren't even aware. A lot of people are, but a lot of people aren't. That there was a bill passed called the Secure Act, and it comes into effect January 1st. And effectively, what that did was it took IRAs and it took what we used to call the stretch IRA and really eliminated it. So if you have money that, and majority of people have their biggest wealth in retirement accounts, 401k, 403b, TSP plans, what it did was now, hopefully you'll spend that money during your lifetime. But if you don't, and when you leave that to your heirs, the Secure Act has now allowed, you used to be able to allow people to leave that money to heirs and they could stretch that money out over their lifetime. That effectively went away January 1st, where the IRS, the government basically said, you now have to, any qualified money or pre-tax money that goes and is left to heirs has to be paid out to them in 10 years. So what that does, John, is that takes that really um, huge tax burden because none of that money has ever been taxed and puts it on the next generation and says, now you're going to have to pay that tax on it. So what we've been doing with a lot of our clients is exactly what you're showing here is taking a look at why don't we take a look at our advantageous tax rates that we have now and convert all that pre-tax money into money that we can have that's after tax that will never be taxed. And that's really what you're doing when you're doing a Roth conversion is you're converting or you're cleaning out the taxes of a pre-tax account and putting it into a tax-free account by paying the taxes now.
And the Roth conversions, we like to tell people these are actually triple tax free, right? I mean,
Yeah.
once the money's in the Roth, you're not taxed on it. If you leave it to your spouse, they're not taxed on it. Leave it to your kids or an estate, they're not taxed on it. So really nobody's ever going to be taxed on it. It's crucial now because we want all the recovery and all the future growth. Anything that we earn, we want it to be earned within the tax free rather than the taxable. So this
Right.
is one of those things that, we actually have a step by step, and I know you'll walk people through this process, right? We have a step by step guide of how to do Roth conversions, how to calculate the tax, how to minimize the tax, and how to get as much of your estate as possible out of government control. So
Yeah, and
yeah, I mean,
especially now, right now, John, if you look at, people are, you're looking at account values and your TSP or your 401k or your IRA is down in value, now may be the perfect time to do that because you're going to pay even less tax because your values are down.
Yeah, that's exactly right. So we have an entire webinar that's just on the Roth conversion. And so, like I said, if you guys want to hear more about any of these specific topics, when you do the evaluations, the surveys, just let us know, and then we'll reach out to you guys and make sure you get invited or your organization gets invited to the areas that you're asking about. All right, so we talked a little bit about tax harvesting. We talked about market volatility. Let me just summarize a couple of these things, Ray, and then you can give me some other thoughts about my summary if you want to add your
Sure.
2 cents. You don't always make more profit when you take more risk, and that's one of the things that we've learned over 40 years worth of research. Think about it logically, everyone. If you take more risk, eventually the risk just means more risk. You don't actually get return for the additional risk. So you got to find out for yourself individually where that sweet spot is so you can maximize your gain but also minimize your risk at the same time. And we don't necessarily have to, and I see people, Ray, I see people with portfolios, they own 25 mutual funds.
Yeah.
And first of all, the whole industry and the world is going towards individual stocks and ETFs. And the reason for that is because we need our money manager and our advisors like you, Ray, we need you guys to be able to trade during the day. Because if we handcuff you by buying mutual funds and you have to buy or sell at the end of the day, you're just getting the leftovers. And that doesn't enable you to do the best job that you possibly can do. And
You
so we
make a
want
really
to,
good point there, John,
yeah.
and most people don't really even realize that mutual funds do not trade um, throughout the day, right? You only get the value of that fund at the end of the day, right? So I recently a situation had a client who was trying to get out of his 401k plan and move it into his IRA, and he called them, he told them to liquidate, and the market happened to be really down that day. And when the money finally moved over to the IRA, he said to me, "How come it's $5,000 less than it was when I talked to them?" I said, "Well, that's because you aren't able to have any control over that in those mutual funds, and mutual funds only get valued at end of day, whereas stocks are valued at the time that you choose that you want to sell them. So you have a lot more control in individual stocks and ETFs than you do with mutual funds, and not a lot of people understand how that works, John."
Yeah, and again, we want to equip our money managers to be able to maximize their potential when they're handling our money. So an ETF stands for what, Ray? Not everybody knows what an ETF stands for.
Yeah, so an ETF is an exchange traded fund, and really what it is, it's a basket of securities. So, for example, if you wanted to buy the S&P 500, for example, it's 500 stocks. Well, you really you can buy all of those stocks with one purchase by buying, for example, SPY. That's the ticker symbol that it trades on, and it's a basket of securities. So when you buy SPY, you own all of those stocks inside of that one purchase. And that can be traded throughout the day. It can be bought in the morning and sold in the afternoon. We typically don't tell people to do that, but it can be traded throughout the day without having to wait until the market closes in order to get that. So we ETFs can be uh, really crucial in investing because you can get into sectors that a lot of times mutual funds can't get. So, for example, John, if you like technology funds right now, and that's a really good place to invest money at this point. If you can buy an ETF that just owns technology funds, right? So you can really get in, and it's not a traded thing where you're getting kicked off capital gains and those kind of things. It's something that you can have much more control over. So ETFs and individual stocks are really the way a lot of people are moving towards, because you have a lot more control over what your investments look like and what you want them to be.
And the evolution of this sort of change from mutual funds to ETFs. The other reason why this is so important, everybody, is because it's cost effective to own ETFs and stocks. There's no underlying or hidden fees like there are in mutual funds. There's no 12b1 asset-based fees, transaction fees, all these other things. So
Much
not
lower
only
cost.
yeah, much lower. So not only does it allow your money manager to enhance his performance, he can do a lot more inexpensively for you. And fees are one of those things where we really feel like we can provide value because there are ways to reduce people's fees. So you want to obviously pay for money management if you're getting quality help. But if somebody's just throwing you into 20 different mutual funds and providing no tax counseling or estate planning or exit strategies for you, we can reduce the amount of fees that you pay drastically. And a difference, in a little bit of fee, a 0.5%, 1%, whatever it is, can really make a huge difference. So,
Substantial. Yeah.
and Ray, that's the last part of it. It's not always about how much you make, but it's how much you get to keep, right?
That's
So
right.
locking in your gains, tax harvesting, Roth converting, saving money on taxes, it's a big deal. Um, we can tell somebody, look, if we have a tax strategy and we can put you into a more tax efficient position, you can make 20 or 24% more money by saving the tax. You can't make 20 to 24% more money with any certainty in any type of investment. It's a huge deal. If you pay less in fee, you can guarantee you make more money because
That's right.
when you save in fee, Ray, you don't just save in fee. You also save what that fee would have grown to.
That's right.
And so, I kind of laugh, and a lot of guys are trying to manage their own accounts. And this is a true story, Ray. I actually had somebody come in that had $2 million in one stock,
Mm.
and their entire life was based upon this one stock. And did the stock make money over time? Yeah, the stock made money over time, but they're completely at risk and vulnerable to the fluctuation of that one company. And
Yeah.
we've seen, and history has taught us that we really need to diversify. And so, when stuff happens like the coronavirus or 9/11 or, unemployment starts to skyrocket, if interest rates go up, how is that one stock going to be positioned versus a variety of holdings that can accommodate different types of environments? And I know
Yeah,
you
well, betting
diversify
on one
people.
horse. I never want to bet on one horse, John.
Yeah, it's too much. So I know you diversify people in different types of investments and accounts, but you also diversify them in different tax vehicles so that they're not all caught up in these government controlled accounts, right? So I think one of the things that we wanted to also send out to everybody in a message today is the government's coming after us, right? Where's all the money coming from, Ray, that they're giving out in this multi-trillion-dollar stimulus plan? Where's all the money coming from that they're going to help use to bring the economy back?
Yeah.
How is the government going to get all this money?
Yeah, I mean, taxes becomes huge, and making sure that you're being as tax efficient as possible is really important because John, the tax break that we got a couple of years ago that was implemented was permanent for corporations. However, it was temporary for individuals. So in 2025, our tax rates are going up, right? And guess what? They're probably going to go up even more because this money that they're getting in these government programs that they're giving out to help small businesses and to help individuals, that's going to come from somewhere, right? It's not just being printed. It's going to come from you and I as taxpayers over time. So if you think tax rates aren't going up, you're very, very naive. You have to understand that tax rates will definitely be going up over at some period of time. They actually already have with the Secure Act, John, where we just talked about earlier, because the tax windfall that the government's going to get from all of this money that's transferring to the next generation with that 10-year payout or having to now pay income tax on all that money that's going to be passed on to the next generation is already very huge. So taxes have become extremely, extremely important in your overall planning, especially when you're moving into retirement.
And so the government, I think the message here is the government's going to come after us. Like they've already changed some massive rules with Social Security. They've taken away some very, very valuable, file and suspend and switch strategies that our clients have really enjoyed for many, many years in Social Security. They're taxing things like the Secure Act. They're going to be taxing transfers on retirement accounts. This is probably just the beginning. So we want people to be aware that we're going to have to be a little bit more defensive strategically if the government comes after our savings and our retirement. And the best place to be is always in tax sheltered accounts because
No
the
question.
government doesn't have any control over those. So diversifying, I know you've always been doing this, but other people, that come into our office or have counsel with us over the phone, they'll have 80% or 90% of all their money in government controlled accounts.
Yeah.
And so they don't have any control, and that's why they feel sick, because the government can change the rules and they literally can't do anything about it. So I'm going to go ahead and switch to the global volatility slide, Ray. This is what I really want to impose upon people and impress upon people right now. We used to have, reasonable models for self-managing our funds. We could look at GE stock that was the workhorse of, 50 years worth of investing and get a pretty steady 80 return. Now nobody wants to own GE stock. People are not being able to keep up with the global economy in certain types of companies, and so people can't do this type of thing alone. There's too many factors and too many variables that everyday people can't take into account. So whether it's the inflation rates, whether it's interest rates, whether it's foreign trade wars, the event-driven corrections like the coronavirus, political skirmishes, military skirmishes in the Middle East, 9/11 terrorist attacks, presidential elections. Our country is so divided politically right now. It's so difficult to tell what is going to be affecting the market performance of our investments. So it's not just about the good old-fashioned 60-40 allocation in stocks, bonds, and mutual funds anymore. It's more about strategic allocation and understanding how, choosing your investments or choosing your investment advisor is just one step of the process. And we have to have somebody that has knowledge in comprehensive planning. We call it macroeconomic planning, to understand the effects not just of your investment, but on how your investment fits into your global economy, as well as how it can be affected by the real global economy at hand. This is really important stuff, and I don't want people to, blame themselves if things go wrong, or certainly don't pat yourselves on the back if things go right. It's not stuff that we can control. And we really want you to understand that the control is a little bit of an illusion. The only things we can control is our own decisions, our own levels of risk, our own strategies, hiring a guy like Ray, making sure that we have a game plan for exiting and for estates and everything like that. Does that sound reasonable to you, Ray?
Yeah, absolutely. And one of the things that you haven't even mentioned here, John, is oil prices, right? And that's been a real big effect on things. I mean, the fact that oil is produced overseas and it's produced here too, but the oil prices really has a huge impact on what we do here, right? So it affects everything, and we are a global economy. Whether we like it or not, it is a global economy, and it's almost impossible to try to predict the way that things are going to go, because we don't have control over what happens in China or what happens in Japan or happens in the Middle East. We have no control over any of that. Like you said, and you said it really good, we really can only control what levels of risk we allow ourselves to take, and making sure that we're comfortable with those levels of risk.
This is an amazing story. I just want to share with you guys just briefly. I have a cousin. So most of my parents and all my relatives, they're all Ivy League educated. They're all intellectuals, did great in school, masters, PhDs, everything. I have a cousin who's an only child, Ray, and I haven't told you this story, but he went to MIT for undergraduate school, went to Wharton School of Business to get his graduate degree. Guess where his first job was on Wall Street? His first job right out of grad school. Close. That's a really close guess. His first day on the job, his firm was raided by the FBI. A bunch of guys and windbreakers came in and raided the place. He worked for Bernie Madoff. Can you believe that? So he had the best education. He's an incredibly brilliant young kid, all the talent in the world, but he just worked somewhere where he had no control over what was happening. And then guess where he went from Bernie Madoff's organization? He then went into the oil business. And so it's been a string of bad luck. But again, these are things that he can't control. He's got such a great outlook on it because he knows he's got the education, the experience. He's going to land on his own 2 feet and do incredibly well. But, the oil well business that he recently got heavily invested in, there's nothing he can do about it. He didn't foresee this. It's not like he made the wrong mistake. Not like he made a mistake. But what he did do was he saved and invested and banked his money. He's getting married this year, hopefully, with everything going on. But guys, just try to understand and just take a deep breath and say, okay, here's my plan. My plan's going to work no matter what. Because I've decided to focus on taxes and risk and fees and exit strategies, my plan's going to work. Whether all these things go haywire, you're still going to be doing the best that you can. You're exercising, you're taking care of yourself, you're doing all the things that are right. These other factors around us, they can't drive our lives. They can affect what happens, but they can't drive our lives, and we want you to be in a position of control. So you are not in this alone. That is the reason why our organization exists. Hopefully we'll get back to a live in-person workshops that we do. Ray and I actually did a couple live in-person educational events together. They went over incredibly well. You guys can probably tell Ray and I are very passionate about what we do. As a volunteer for our organization, Ray has really stepped up and offered his services out to anybody who wants counseling. But he's not a professional speaker. I'm not a professional webinar presenter. This is not what we do, but we're trying to do our best to get as much education and resources out to you guys as we possibly can. We're going to do these every single week, probably even after our whole pandemic has died down or even gone away. We're still going to do these online webinars because that's how people receive information. You can be comfortable, take notes, research on your own. Then you can reach out to us and let us know what you guys want some help with. And we're always going to focus on the things that we can focus on, which are taxes, fees, risk, how much you can save, having a budget, having exit strategies, those types of things. The reason why our educational nonprofit, I believe, really sets itself apart is we have guys like Ray. We don't just say, oh, any financial planner in the world can sign up, volunteer for us, and go out there. We vet these guys. We look for the best of the best. We're looking for educational background. We're looking for decades of experience. We're looking for credentials. We're looking for, Ray was voted by his peers and by his clients as the advisor of the year for Annapolis, Maryland, multiple years in a row. There's only one guy that can say that, and obviously his charm and good looks don't hurt him. But we really appreciate that he believes in our cause, and we want our value to be brought directly to your family and know that our resources are available for you guys. So please take a few seconds to fill out the survey. Schedule a telephone conference with Ray or I or one of our other highly credentialed and experienced volunteers, and make sure you think about, well, who are you getting advice from? Right? What is their background? What are their credentials? What is their experience? And how are they reaching out to you in the times when you need advice the most? And if you think you guys might be lacking in that type of attention or that type of advice or knowledge, we're not here to replace anybody. We are here to complement and supplement what you guys are doing right now. So Ray, once more, thank you for joining us today. We really appreciate your partnership, and we really also appreciate what you guys have done to help our cause for education. And hopefully you can join us on some more educational webinars in the future. And do you have any closing remarks that you would like to make to people?
No, just thanks for having me, John. Again, I appreciate the fact that you're doing this and putting out education to people and allowing people to kind of learn a little bit. Hopefully they got something from our talk today. It really, I always tell everybody that I meet with, it's education is really the key. And understand that, if you have somebody that you're working with, understand what their motivation is, right? Make sure that their motivation is to help you and their motivation is not to something to sell you. So I really encourage people to reach out and try to get as much education as possible, because education is power, and I truly believe that. And I think that's how people can really be successful in their overall investing and in whatever they're trying to accomplish, whether it be retirement, college, whatever the issue is or the financial goal is. Get as much and as competent education as you possibly can.
All right, Ray, those were great words of advice. Thank you, everybody, for attending today's webinar. We'll look forward to getting your feedback on the survey. Have a wonderful and safe week, and hopefully we'll talk to you soon. Thank you, and great day.